Hello everybody, the topic of this section is estimating a project's cash flows. Project cash flow forecasts are built up from estimates of the incremental revenues and the costs associated with the projects. In this section, we will discuss how cash flow estimates can be derived from estimates of a project's sales volume, selling price, and fixed and variable costs. Suppose you are a manager in the personal computer division of Compuso Corporation, a large firm that manufactures many different types of computers. You come up with an idea for a new type of personal computer, which you call the PC-1000. If your project idea gets to the point at which a large sum of cash must be expended, then you must prepare a capital appropriation request that details the amount of capital required and the projected benefits to the corporation from undertaking the project. The following table shows the estimated annual sales revenue, operating costs, and profit for the PC-1000. It also shows the estimated capital outlay required. Let's see in detail. This table is constructed under the assumption that sales will be 4 units per year at a price of $5,000 per unit. This means the first term in the table, sales, will be 4,000 units multiply the price $5,000, $20 million. A new product facility will be leased for $1.5 million per year and suggests that the lease payments in the fixed costs will be $1.5 million per year. In further, it is assumed that the property taxes will be $200,000 per year. The cost of administration will be $600,000 per year, and the cost of advertising will be $500,000 per year. Besides, the production equipment will have to be purchased at a cost of about $2.8 million. The equipment will be depreciated over 7 years using the straight-line method. This means the depreciation will be $2.8 million over 7, $400,000 per year. It is assumed that the other cost will be $300,000. So take the cost of all former 6 terms together. The total fixed cost will be $3.5 million per year. The next part is variable costs. For each computer unit, the direct labor is $2,000. The cost of material is $1,000. The selling expenses are $500 and the other cost is $250. Take the costs of these 4 terms together. The variable costs per unit are $3,750. Then the total variable costs for 4,000 units is 4,000 multiplied $3,750, $15 million per year. In further, the total annual operating costs are equal to the total fixed costs, $3.5 million per year, plus the total variable costs, $15 million per year. Is $18.5 million per year. Then, the annual operating profit can be obtained by the sales minus the total annual operating costs, that is, $20 million minus $18.5 million is $1.5 million per year. At a tax rate 40%, the corporate income taxes are equal to the annual operating profit, $1.5 million multiply 40% and are $0.6 million per year. So the after-tax operating profit is annual operating profit $1.5 million minus the tax $0.6 million and is $0.9 million per year. In other words, The corporate net income is $0.9 million per year. Up to now, annual sales revenue, operating costs, and profit have been calculated. The last part is forecasting initial capital outlay for this project. There is a purchase of the production equipment which will cost $2.8 million. In addition, it is estimated that there is a need for $2.2 million for working capital. Note that this $2.2 million working capital is required at the beginning of the project and the following operating years. However, it will be got back at the end of this project's life. So the total capital outlay required will be the sum of purchase of equipment, $2.8 million, and working capital, $2.2 million, that is $5 million. That's all about the forecasting cash flows for the PC1000 project. Now consider the project's expected cash flows in the future. The natural planning horizon to use in the analysis is the 7-year life of the equipment, because the equipment will be depreciated over 7 years using the straight-line method, and a new decision would have to be made about whether to renew the investment at the end of the 7 years. In years 1 through 7, the net cash inflow from operations can be computed in 2 equivalent ways. The approach 1 is cash flow is equal to revenue minus cash expenses and minus taxes. The approach 2 is cash flow is equal to revenue minus total expenses minus taxes and plus non-cash expenses. Because the revenue minus total expenses and taxes leads to the net income, the cash flow is also equal to the net income plus non-cash expenses. For the PC1000 project, there is only one non-cash expenses, the depreciation $0.4 million. The following table can be referred and it is selected from the formal forecasting table. In approach 1, the revenue is sales $20 million. The cash expenses is the total annual operating costs minus the depreciation, that is 18.5 minus 0.4, and is $18.1 million. And the taxes are corporate income taxes at 40%, $0.6 million. So the cash flow is equal to 20 minus 18.1 minus 0.6 and is $1.3 million. In approach 2, the revenue is sales $20 million. Total expenses are $18.5 million. The taxes are $0.6 million, and the non-cash expenses are the depreciation $0.4 million. So the cash flow is equal to 20 minus 18.5 minus 0.6 and plus 0.4 is $1.3 million. By approach 2, the cash flow is also equal to net income plus the non-cash expenses, that is, after-tax operating profit $0.9 million plus the depreciation $0.4 million is $1.3 million. Therefore, the two approaches always result in precisely the same estimates of the net cash flow from operations. Next, let's summarize the project's cash flows. There is an initial outlay of $5 million, cash inflows of $1.3 million at the end of the years 1 through 7, and an additional $2.2 million cash inflow at the end of the project's life in year 7. The cash flow diagram for the investment therefore looks as follows. Assume that the cost of capital for this project K is 15%. the present value of each year can be obtained as the last row of the diagram. Taking sum to these present values, the net present value of this project can be obtained like this NPV formula for projects. Finally, the NPV of this PC1000 project is $123.6 million, and the cash flow estimate is completed. What would be the NPV of the PC1000 project if the variable costs are $4,000 per unit instead of $3,750? This means the variable costs are changed to $4,000, which leads to the changes of the total variable costs and profits. So we should redo the table about forecasting cash flows for this project like Formula 1 and summarize the project's cash flows again. Then, the net present value NPV can be calculated by the NPV formula of projects. In summary, we have studied the construction of a table about forecasting cash flows for a project, cash flow estimates, and the calculation of the NPV for a project in this section. That's all about this section. Bye!